हेलो स्टूडेंट्स, वेलकम टू सागर शर्मा क्लासेस। आज हम आपके लिए क्या है इम्पोर्टेंट टॉपिक कॉस्ट ऑफ कैपिटल, its meaning, significance, and determinants and calculations. As we already know, there are various sources of capital. Like first one is equity, and second one is preference share capital. Third one is debentures or debt, and fourth one is retained earnings. And in debentures we will also include the long-term loans like this. So for all these sources we have to calculate the cost of capital in finance. So what is basically cost of capital? It is also known as the hurdle rate of return and the minimum rate of return expected by the providers of capital. These are your shareholders, lender, and debt holders to the business as a compensation for their contribution to the total capital. There are various definitions, like cost of capital may be defined as the rate that must be earned on the net proceeds to provide the cost element of the burden at the time they are due. And cost of capital is the minimum required rate of earnings or the cutoff rate of capital expenditure. And it is a cutoff rate. This is also known as cutoff rate for the allocation of capital to investment of project. It is the rate of return on a project that will leave unchanged the market price of stock. So now, why we calculate the cost of capital? Why it is useful in finance? Firstly, it will useful for the investment evaluation, for discounting expected annual and terminal cash inflows and outflows. Whenever we are using capital budgeting techniques, we will use this cost of capital. That is also called the minimum rate of return, and it is also helps in designing capital structure. Whenever we are creating our debt equity mix or capital structure, so we will have to focus on this cost of capital, and it will also help in financing decisions and choosing one of the two sources of finance. It is also useful. And if we want to design optimal credit policy for calculating cost of funds blocked with customers, like we are here design in the help of debtors, how much time we should provide to the debtors for the payment and financial performance appraisal. It is also useful in the for comparing actual rate of return and cost of capital. So it is also helpful in financial performance appraisal. Now, what are the determinants or factors affecting cost of capital? First one is investor expectations. So about the annual return, terminal return, and capital gains, what are the investors' expectations and expectations of market intermediaries? What are the commissions to broker, underwriters, merchant brokers, etc.? And what are the corporate tax rate? Corporate tax reduces cost of borrowed source as interest qualified for tax rebate because interest is a tax deductible expense. And net cash inflows at the beginning, so it means net proceed or the amount realized from a source of capital. So amount of capital plus if it is issued on premium, then we will add, and if it is issued on discount and issue expenses also will be deducted. This is also a factor. And net cash outflows. What are the net cash outflows? It includes interest on borrowing, dividend on share capital, and redemption value of external contributors of capital. Now, I have already told you in the starting of videos, we will calculate cost of debt, cost of debenture, cost of preference share capital, cost of equity capital, and cost of retained earnings. And where we will combine, whenever we will calculate combine, it is known as WACC, weighted average cost of capital, or we will call it overall cost of capital. So firstly, see individual calculation. How will you calculate cost of debt? Cost of debt after tax, interest proceed. We can interest upon net proceed, and it is 1 minus tax because interest is a tax deductible expense. So we have to deduct tax here. Cost of debt taken from bank or financial institutions for a specific period at a certain rate of interest is calculated by this formula. And we have already told you I is here amount of interest payable at year end, and NP is net proceed. How will you calculate net proceed? Amount of debt minus if there is expenses on arranging debt, and T is corporate tax rate. You can take, we have taken a simple example. Company has taken loan of rupees 10 lakh from IDBI at 10%. So rate of interest is given 10%, and 10 lakh 10% you will calculate, it will come 1 lakh interest. And net proceed you can calculate. We have taken 10 lakh and the legal expenses 20,000. So 10 lakh minus 20,000, 9 lakh 80,000, it is your net proceed. and tax rate is 35%, 1 minus 0.35. So you can say it will come 6.63%. Second one is cost of debenture. So there are two types of debenture, redeemable as well as irredeemable. So if the debentures are irredeemable debenture, it means it is perpetual debenture. So it is the same formula, that is the formula of cost of debt. But in the case of redeemable debenture, we will use this formula: interest plus maturity value minus net proceeds upon number of years, and MB plus NB upon 2, interest minus tax. Here MB is maturity value, NP is net proceed. So we will calculate by face value. If this is premium, then we will add, and if it is discount, we will minus. And there is issue expenses, we will also deduct. N is the maturity period. So cost of debentures, you can see we have taken a formula. Company issued 10% debentures of ₹100 each at 2% discount. These are redeemable. The N is given 5 years at 3% premium. So maturity value is 100 is your par value and 3% premium. 103. So 103 net proceed, you can see 100, and it is discount at 2% discount, and issue expenses are 1%. So it means 100 minus discount is 2 and issue expenses is 1. So it will come 97 net proceed. Number of years. So by this calculation, you can see it will come how much? After calculating, you can see answer is not given, but the answer will come. Yes, answer is given 7.28%. Now, third one is cost of preference share. This is also similar to cost of debenture, but here tax is not deductible because preference share is dividend paid after the tax, after the net profit. It is the appropriation of profit basically. Preference share can also be redeemable or redeemable. So if this is irredeemable, simple formula, preference dividend upon net proceed. And if it is redeemable, same formula, dividend plus maturity value minus net proceed upon N, MB plus NB upon 2. So dividend on preference share capital is paid out of post-tax profit. So the cost of profit, preference share capital is already after tax. Now, very important, this is very important, cost of equity. Cost of equity capital is calculated in different ways depending upon choice of firm, situation, and availability of information. Popular method you should know: earning yield approach, dividend yield plus growth approach, dividend to average net worth approach, and CAPM, capital asset pricing model. Whenever the question is asking which is the most important and popular method, then this is the answer: CAPM, capital asset pricing model. Now see, by the earning yield approach, we can use the formula EPS upon MPS. Earning yield approach, we can use this to calculate the cost of equity. And dividend yield approach, DPS upon MPS. This is very simple formula. Expected DPS at the year end, and MPS is market price share. In case of newly establishing company, we consider net proceed in place of MPS. Remember this one. Now dividend yield plus growth approach, if the growth is also given, so you can use DPS upon MPS plus growth percentage. This is very simple formula. And G compounded, if it is given like this, compounded annual growth rate in dividend is calculated as, so dn upon d0, 1 upon n minus 1. So dividend paid in ending year, dn, and d0, dividend paid in ending year, and n is n minus 1. But this is used in case of compounding. You can see if dividend paid in year 16, 17, 18, 19, 20 was 10, 12.5, 15, 7.5, the growth rate will be. How will you calculate? So you will see the starting and the end. So in the end it is 20, and in the starting 10, and there is 1 upon n. So there is 4 years now. So 1 upon 4 minus n, like this you have to do. Dividend to average net worth approach. So if the question is given average net worth, you can use this formula: dividend upon average net worth. Net worth is calculated, net worth in the beginning and net worth at the last. So you can calculate the average net worth also if the question is giving according to this. So you have to see the information in the question, then apply the formula, which formula you use to calculate the cost of equity. Last one, very important, CAPM. This is very simple formula of cost of equity, risk-free rate of return plus beta, and risk market risk premium and risk-free rate of return. Remember this formula, very important. You can see the example. Risk-free rate of return is 5%, market rate of return is 14%, and security beta coefficient is given 0.8. What is the cost of equity according to CAPM? So risk-free rate of return is given 5, beta is given 0.8, and market return given 14, and risk-free rate 5. So whenever you will solve it, it will come 12.2%. Now, the last source of capital is retained earnings. In the most similar cases, cost of equity and cost of retained earnings is same if there is no information available. Retained earnings appear to carry no cost as they represent funds which have not been raised from outside. But the opportunity cost of dividend foregone by shareholder represent the cost of retained earnings. In general, cost of retained earnings is considered as equal to cost of equity, but in reality, KR is less than KE due to implication of personal tax on dividend and the inflation cost. So how will you calculate cost of retained earnings equals to cost of equity 1 minus personal tax rate and 1 minus if there is flotation cost. So if cost of equity firm is 20%, flotation cost is 5%, shareholder personal tax rate on dividend 30%. So the cost of retained earnings you will calculate by this formula. KE 1 minus TP and 1 minus flotation cost. Remember this. So thank you. I think you remember all the formula and the various sources of cost of capital. If you have any doubt, you can ask in the comment section. Thank you.